depth study daily candle, we can see it's a big up bullish candle. But if we go down to the hourly chart, we can see what happened during that period of time. We can see that the top of the body here coincides with the level of kind of support resistance that was encountered. So encountered some resistance here on the hourly chart, broke through it, and then came back and tested that as support, and that is where it's closed at. So we can get a more in-depth picture by looking at a lower time frame, and that can be useful to us in terms of making our trading decisions. So let's talk about the anatomy of a candlestick, okay? And that anatomy is going to have some key characteristics. Now, the size or range of a candlestick is important, okay? The body shows commitment from both the buyers and the sellers, and the tails or wicks, shadows as they're also known, show rejection, okay? Now, if we look at these candles here on the right, we can see that they are all bullish candles. The first is a clearly bullish up candle, open near the bottom, closed near the top. The second candles are also bullish, okay? Now, even though they've got these big shadows down at the bottom, what these are telling us are that sellers came into the market, pushed price way down. At one stage, both of these would have been, down, big down, bearish looking candles, but buyers came back in and pushed price back up. In this example here, it's pushed it up to the top of the candle. In this example, it's pushed it up to near the top, okay? Either way, this is showing commitment from the bulls. It's shown that the market has tried to test lower, and that has been rejected, that sellers couldn't keep that price down there. Now, the converse is true here. If we look at these candles, we can see high commitment from the bears. So basically, in this example, the tails here imply a rejection of the highs. So in both of these examples where we've got the long tails, these again would have been big bullish green candles, but sellers then came back into the market. The market rejected these highs, and that is what these shadows are telling us, okay? And that is why all three of these candles are bearish. Now, we also have kind of indecisive candles with narrow ranges. So narrow candlesticks, as we have here, where there's not much difference between the open and the close, kind of really represent indecision by both bears and bulls. There's been a tug of war, a battle between buyers and sellers, and there's been no clear-cut winner. And all of these types of candles can be interesting to us and useful to us, but it's all to do with the context of where we see them in relation to other things around them. So that is why, to gain a full picture, we really need to read each candlestick in conjunction with its surrounding neighbors and not in isolation. We get some information, we're looking at them in isolation, but it's all to do with context, and this is what gives us an indication of a trend's momentum. Alright, so let's look at candlesticks within the context of a trend. Now, often the worst place to join a trend is after there's been a large move in the direction of the trend, because price cannot move in a straight line, at least not for very long, because the definition of a trend, price moves in the direction of a trend and then it pulls back. And if it's had a big move in the direction of the trend, the likelihood is that it is going to pull back. And the end of a move in the direction of the trend often occurs with large candles. So we can see we've got some examples here. Price has a big move up and then it pulls back. Big move up and then it pulls back. So when you see a big candle moving in the direction of the trend, that gives you an indication that that trend may need to pause and take break for a while. Doesn't mean the trend is over, but it means the likelihood is the next move is likely to be back, that we're likely to pull back before we move in the direction of the trend. Now, these candles can typically signify exhaustion of the current move, so it gives us a clue that the move is nearly over. Now, we never have certainty that the move is over, just increased probability of a pullback, but that is something that we need to be mindful of. Now, looking at this price action, here we have an example of where amateurs might look to join a trend. Take a look at the market, think this market's going to the moon, I need to get on board before I miss out. Well, this line of thinking is very flawed, and hopefully we've illustrated that on the previous slide. Right here is the worst place to join because price action is probably exhausted. So the probability of a retracement is very likely, turning this into a losing trade for the unwary amateur. Trading is all about timing, and this is most certainly not the right time to be entering a trade. On the other hand, professional traders usually join a trend as the momentum is about to continue in the direction of the prevailing trend. So we want to look for a pullback, okay? Now, at this time, candlesticks are going to get smaller, signifying a temporary pause. So we've waited for price to pull back. We're now seeing the small candlesticks representing that we might be looking at the next move up. That is how we want to time our entry. Therefore, when we see this kind of indecision in conjunction with a pullback, this is often the best time for us to join a trend. Okay, so let's take a look then at candlesticks in a trend, which is really going to help us read the signs of what is actually going on. So here we are looking at a weekly chart. So bear that in mind. This is a weekly chart, long-term chart. And what we can see here on the British pound versus the US dollar is that price has formed a level of support at 1.2674. So for us to be looking at a true valid level of support, we want to see a minimum of 2 touches for it to be true support. And here we can see we've got 1, 2 and 3 touches. So we're satisfied that this is a robust defined level of support. So our view would be that if price breaks through this would be bearish, and if it breaks through, the likelihood is that this move will continue to the downside. So we're obviously looking at a trending market. We're in a downtrend. We know this because we are making lower highs and lower lows until we get to here where we are making equal lows. If we're making equal lows, the trend is still intact. You're just waiting for a breakthrough and the next lower low to occur. So what happens next? Well, price breaks through support, and this is really showing commitment from the bears. Okay, we can see we've got some bearish price action here at play, and this is telling us that this move is likely to continue in the direction of the downtrend. The downtrend is likely to continue. But what happens next? Well, we can see that it hasn't broken through cleanly. We've had what we refer to as a false breakout, and this is pretty common in the world of trading. Any of you who trade breakouts would be familiar with this. Price has broken through, and then that move has been rejected, and price has moved back up. What was support, it has then gone through it as resistance quite cleanly, and we are now back above this level. So the bulls have rallied, and the break of support has been rejected. Okay, so this has the potential to spark a trend reversal. Okay, now this could be of interest to us. Now bear in mind, we are looking at a weekly chart here, so this is long term. So it's always interesting to look at these longer term charts for maybe a piece of market direction. So if you have a rejection of a level on a weekly chart and a trend reversal, you then have the opportunity to trade what you're seeing on the weekly chart down on a lower time frame. So this will allow you to get a tighter entry with a better risk to reward ratio. So this is why You know, I personally have never traded a weekly chart in my life, but I do look at weekly charts to get a view, an understanding of the probabilities of what might be happening on a longer term basis. And we can see now that, you know, we are looking at a move up. So we haven't moved into an uptrend yet, you know, because we haven't got a series of higher highs and higher lows. But you can see we've taken out a previous high here, and this price action is certainly now looking bullish. So, you know, if we're seeing bullish price action on a weekly chart, this can affect our thinking on the lower time frames and how we react and build into our trading decisions there. So just something for you to bear in mind. Okay, so let's move along then and look at how we analyze the momentum within a trend. Now, as I said earlier, not all trends are created equal. Just because we've identified a trend doesn't necessarily mean that we will want to trade it. So how do we differentiate the better quality trends from the rest? Well, a very useful tool for us is the moving averages. So, you know, moving averages can really help assist us in terms of making our trading decisions at the turn of momentum within the trend. Now, by reading the price action alongside the moving averages, it can help show us when price equilibrium has been reached, and this is when we look to trade as the momentum continues in the direction of the prevailing trend. Now, what we're looking for with our moving averages is, you know, a sign that we're dealing with a good quality trend, and we can also use it to help time our entry into a trade. So let's explore this a little more fully. So what we can see here is we've got a chart here. We're looking at gold. We can see we're looking at a good uptrend. Okay, we're making a clear series of higher highs and higher lows. So what we can also see is we've put on our moving averages. So we are using the 10, the 20, the 50 and the 200. Okay, so we use the 200 to give us the longer term view, the 50 the medium term view, and the 10 and the 20 to give us the short term view. And we can see here that, you know, we've got a clean, smooth flowing trend, and we can also see our moving averages are clean, smooth, flowing nicely, and that's matching it. So what we want to see in an uptrend is basically what we see here. Okay, we want to see the 200 period moving average on the bottom. We want to see the 50 period moving average above the 200. We want to see the 20 period moving average above the 50 and the 10 above the 20. Okay, so we want to see them all moving in the same direction as the trend with good space between them. Okay, if we see that, we refer to this as a fanning pattern. Okay, so first thing we're looking for when we're identifying potential opportunities, we want to see a trend. We want to see a trend at play. Okay, so next thing we then want to see, we want to look at our moving averages, and we want to see that we have this pattern in place. Now we want to see that, we want to see, you know, no crossover, we want to see good space between them. Now this would be reversed if we were in a downtrend. In a downtrend, we'd want to see the 200 period moving average on top, the 50 below the 200, the 20 below the 50, and the 10 below the 20. So this is how we identify the better quality trends that are out there. So let's take a look at this. Okay, so, you know, if we removed our price action now, so we are just looking at the moving averages in isolation, we can see that, you know, that the kind of periods of smooth sustained trend become apparent. We can see here, you know, on the kind of middle part of this chart where the moving averages have just come into alignment, the 50s above the 200, the 20s above the 50 and the 10s above the 20. You can see we have a good period of time here, and then, you know, this trend would have been nice and strong and robust. You know, once these moving averages have started crossing over, that this trend has run out of steam, it's run out of momentum. You know, the 20 crosses over the 20, sorry, the 10 crosses over the 20 then crosses over the 50, so the trend's probably reversed at this stage, and then we can see it's got underway again in terms of an uptrend when our moving averages have come into conjunction and alignment here. Okay, so we mark these in and put on our price action, and we can see that price is kind of confirming what we thought just by looking at our moving averages. Okay, so what we can see is the periods of time we thought, you know, which is pretty much where our moving averages have come into alignment. You know, price action is nice and smooth. We're uptrending nicely, okay, up until the point where this trend runs out of steam, and where the moving averages are kind of crossing over one another and they're choppy. You know, this is not a period of time that we would want to be getting involved. We would sit on our hands during this period of time. It's not a market that we would be looking to get involved with. And then we can see when our moving averages come into alignment again, you know, this reflects that the move is again looking strong, and we are trending nicely in the direction of the moving nicely in the direction of the trend. So for me, the moving averages and the candlesticks just, you know, really put together give you a good view on what the market is doing, what price action is telling you. So, you know, if we could only choose one thing to trade with, we would trade with candlesticks in isolation, because that tells us what price is doing. Adding the moving averages to that gives us a higher level of confirmation, helps us identify you know, quite easily visually what the better quality trends are. So very, very useful in that respect in terms of helping us to, you know, quantify what the better quality trends are. So safe to say then that, you know, it's during these periods of smooth sustained trend that we begin to look to stalk opportunities. When we see that price action is trending and it's confirmed for us by our moving averages, that is when we become interested in stalking a trade. However, we will always need more information than this before we can trade. Okay, so what these, you know, this information is telling us is that the market conditions are potentially going to be right for us, you know, in terms of looking for timing an entry, but we still need to time that entry. So as we said before, when we're in an uptrend, we're looking for the 10 period moving average to be above the 20 period moving average. We want to see the 20 period moving average above the 50 period moving average, and we want the 50 period moving average to be above the 200. When we see that, we know that we are dealing with an optimum trend. So we see this. What does that mean? It doesn't mean we jump into a trade, obviously, as we've discussed, but we now have a market to put on our watch list. We now have a market that we can focus on and wait for an entry to occur. So we keep that on our watch list as long as that trend continues. If we get a trade set up, great. If the trend breaks down, then it moves off of our watch list, and it will stay off of it until the trend resumes. So that is how we go about, you know, identifying trading opportunities in the markets. So we've talked about how we use our moving averages to identify better quality of trend. How do we go about using our moving averages to help us stalk an entry to a trade? Well, moving averages are very, very useful, okay, in this respect. And by assessing a trending price chart, the levels of equilibrium within a trend can be easy to spot. So what do we mean by equilibrium? So we've already said in a trending market that price is going to move up, and then it's going to pull back, and then it's going to move in the direction of the trend again. So price is going to often turn back in the direction of the trend at these levels of equilibrium. This defines for us a trading zone. So we can use the moving averages to help us identify a level in price action where we can expect a pullback to occur to. So if price does pull back to this level, to the moving averages, that is then another probability stacked in our favor that we may have identified the turning point, and it might be a good time for us to consider initiating a trade. Again, we don't do this just because price has pulled back to the moving averages. It is another consideration for us. We will always be looking for more information to help us build into a trading decision. So we view these zones in price action as kind of buy zones if we're in a downtrend, sell zones if we're in an uptrend. So what we're looking for, and what you'll notice, okay, is that when price is trending and our moving averages are in the optimal geometry, here in this section that we've highlighted red, we are in a downtrend, and price will move down and then often pull back to the moving averages, to the zone between the 10 and 20 period moving average. Okay, so we're going to refer to this as the red trading zone. So price will often pull back here before taking the next move down. So it does that here, pulls back to the red zone, and then takes the next move down. It then pulls back to the red zone again before moving down for the next leg. Okay, so when price pulls back to this zone when we are in a downtrend, we're on alert now that a trading opportunity might well be setting up. Again, we don't just go short because it has pulled back to this zone. We're looking for more information, but it is another ingredient, okay, another ingredient stacking in our favor. Okay, so the same is true when we're uptrending. So we're uptrending here, clear series of higher highs and higher lows, and our moving averages are in the optimal geometry. 200 on the bottom, 50 above the 200, 20 above the 50, and the 10 above the 20. Again, you will notice the way that price continually moves up, pulls back to the green trading zone. So this area between the 10 and the 20 period moving averages, when we're in an uptrend, we can refer to this as the green trading zone. And when price pulls back to here, as it often does, we can look to stalk long opportunities. So we can see price pulls back to this zone, then moves up, pulls back again, moves up, pulls back, moves up. And in a sustained trend, you will notice this behavior over and over and over again. Okay, it doesn't guarantee that we're going to have a successful trade just because we see this, but it is another opportunity, it's another probability stacking in our favor. So when we pull back to the red zone, when we're in a downtrend, we look to stalk opportunities to go short. When we pull back to the green zone, when we're in an uptrend, then we are stalking opportunities to go long. So the moving average zones represent an area of equilibrium within a trend. They represent an area of fair value. When prices pull back to this zone, it's pulled back to an area of fair value, and this represents an area where we would consider initiating a trade if other technical factors are stacking up and building towards us making a good trading decision. Alright, so how do we build towards a good trading decision? So we look to combine our moving averages with the information that the candlesticks are giving us. So this really goes together, okay, giving us a good way to build into a trading decision in terms of an actual trade entry. So once price is back in the trading zone, we then stalk our entry using candlesticks. So we wait for price to pull back into the zone, and then we are looking for a specific type of candlestick to form. Now you'll notice here, okay, we've highlighted it for you. You'll notice when small indecisions candles form in the sell zone, quite often the next move in the direction of the trend will occur. Okay, so we move down, we pull back to the zone, small indecisive candle, and then we have the next move down. Okay, again we move down, then we pull back into the sell zone, and a small indecisive candle occurs before the next move down. These small indecisive candles often indicate that there is going to be a change of direction. So if we've pulled back, the change of direction is likely to be in the direction of the trend. So The fact that we've got an indecisive candlestick is one factor in our favor. It's one probability. The fact it's occurring in our zone, our trading zone, is another. And we are all about stacking probabilities in our favor. So these small candles become our trigger candle for a potential trade. So this is like the final piece of the jigsaw that will trigger us into a trade. Okay, so we have a trending market. Our moving averages are kind of in the correct order for us, the optimal geometry. We've pulled back into the trading zone. Then we have a small indecisive candle. That would be the trigger for us to enter a trade. I will explain exactly how we go about doing this, but there is one additional consideration for us to factor in as well in terms of building into a trade decision. So as trend following traders, one thing that we need to consider before entering a trade is the likely continuation of price momentum. So we've already identified a trending market. We know we're looking at a good quality trend because we've looked at our moving averages. So that is good, and that is certainly, the foundation that we are then looking for in terms of potential trade. But just because we have a trend in play doesn't mean that that trend is going to continue. I'm sure many of you will have heard the expression, the trend is your friend except at the end. So is there a useful way of identifying when a trend might be about to come to an end? Well, there is a very, very useful technique that we can consider when it comes to price continuation. Okay, and this technique is basically to measure a price's momentum. So this allows us to get an understanding as to whether that trend is likely to continue. Okay, so how do we actually go about doing that? Well, we do this by checking for convergence between price and either a trend or momentum based oscillating indicator. Now that is not as technical as it sounds. So basically what we're looking for is for an indicator to confirm what price is telling us. Okay, and this tends to be a very useful signal for us. Alright, so let's look at this and get an understanding for what we're looking for. So basically we're looking for trend and indicator agreement. So variety of different indicators you can use for this. So the indicators that I and my colleagues use in our trading and that we are showing on these charts are both the MACD and the RSI. Now these are traditional indicators and are often used to indicate overbought and oversold conditions. So we are not that interested in that information. Kind of the traditional indicators, when used in the traditional ways, I found that the results are less than optimal. But what I have found them to be very, very useful for is for helping us to assess the strength of a trend. So what we're looking for here, so we've got on the left the US dollar versus the Canadian dollar on a daily chart, and what we can see here quite clearly, based on what we've already covered, we're in an uptrend. We're making a clear series of higher highs and higher lows. The next thing we're looking at is our moving average geometry. Again, is optimal. 200 on the bottom, 50 above the 200, 20 above the 50, and the 10 above the 20. Okay, all looking good. Okay, price is made a higher high, and we're very close now to our moving average buy zone. Okay, so there's no doubt that we are dealing with a good quality uptrend here. But how likely is it that that trend is going to continue? So what we're doing, okay, is we're comparing the highs in price with the highs on our indicator. So in an uptrend, we are only concerned with the highs. And what we do is we look at a high in price and then we compare it to the high on the indicator. So we can see our first high on the left, we make a high on our indicator. Price moves on and makes a higher high. And as price makes a higher high, the MACD makes a higher high, so this high is higher than the previous high, and the RSI makes a higher high, so the high on the RSI is higher than the previous high on the RSI. So price is confirmed by what the indicator is telling us. So the indicators are confirming what price action is telling us. Again, we move on and make a higher high. We make a high on the MACD and a higher high on the RSI. So we are converging. Again, move on and make a higher high, and we make a higher high on both the MACD and the RSI. And then we make our final higher high here. Again, make a significantly higher high on both the MACD and the RSI. So we have convergence here. This is indicating to us that the probability is that this trend will continue. It doesn't guarantee it, because there are no guarantees, but it's another probability stacked in our favor. Conversely, if price had made a lower high as price had made a higher high, we'd have divergence. That would be a massive red flag for us, and we would stay out of that trade. Okay, so that is how we assess indicator convergence in an uptrend. If we look at our piece of price action here on the right, we can see again we're on dollar CAD and we are in a nice downtrend. Okay, clear series of lower highs and lower lows, moving average geometry again optimal. So in a downtrend, we are comparing the lows in price to the lows on the indicator. So we can see we make a low in price, we have a low on that MACD and a low on our RSI. Price then moves down and makes a lower low. So we look at our MACD, and the low on the MACD is significantly lower than the previous low, and then the same on the RSI. We go on and make a further lower low here, and the low on the MACD is lower than the previous low. The low on the RSI is lower than the previous low. So again, we have indicator convergence. So that means it's like a health check for the trend, okay? And if you have convergence, you've been given a clean bill of health. There's no guarantee that you know, that the trend is going to continue, but the probability states that it is. And conversely, if we had divergence, so if price had made a high, if the indicators had made a higher low here as price has made a lower low, that would be a massive red flag, and that would indicate with a high probability that that trend was running out of momentum. Okay, so one thing to remember when it comes to convergence, in an uptrend you're comparing the current high with the previous high. Okay, that is what is important, the current high and the previous high. What's happened previously is of interest to us, but you make your decision based on the current high and the previous high and whether you're converging or diverging. In a downtrend, you're basing your decision on the current low and the previous low. Okay, what's happened before is of interest, but what is happening right now is where we make our trading decisions. Okay, so this is where the rubber really meets the road, because now we're going to focus in on finding and taking trading opportunities within the trend. So here we're going to cover the strategy rules from start to finish, exactly what we are looking for to find a trade that is eligible for us to place an order on. So we are basically going to find a good trading opportunity and apply our rules to it. If our rules are all met, then we have a trade. If we don't, if they don't meet all the rules, then we move along and we will be looking for a better opportunity. So here's where we put it all together, all of the concepts that we have covered in this webinar, which built upon the concepts that we had covered in part 1 of this series. So it's safe to say that trading is all about timing. When it comes to trading, timing is everything. You can be right about the trend, you know, the long-term direction of it, but if you get the timing wrong, you can still end up with a losing trade. Okay, that is why timing is so important. And I think of it a bit like if we're going to get on a train. Okay, so if you're boarding a train, you wouldn't try and jump on the train while it's moving. Certainly not unless you were a trained stunt person. Okay, what you would normally do is wait for it to pull into the platform, stop, the doors open, and then you get on in a safe and controlled way. And it's absolutely the same with this trading strategy. What we're looking for is the momentary pause at the station platform before we look to board the train. So let's take a look then at the strategy rules as we build into a trading decision. Alright, so the essential rules for this strategy are this. We want to see price in a clean flowing trend. Okay. We want to then see that the moving averages are correctly aligned. So flowing trend, clean trend is good. We need it to be confirmed by the moving averages. If we see the moving averages are in the optimal geometry, then that is the confirmation that we need to see that we are looking at a strong and robust trend. We then want to see that price has pulled back into the trading zone. Okay, and then once it has pulled back in there, we're looking to see a small indecisive candle form there. Okay, so if we see that, those are the essential rules that we want to see. Plus, we want to see that we've got momentum agreement between price and the indicators. So if we have convergence, our trend has got a clean bill of health. If we do not have convergence, then this is a bad sign and we would steer clear of the opportunity. It wouldn't be one for us. And as I said before, if we have convergence, it doesn't guarantee that the trend is going to continue. But if we have divergence, if price and the indicators are not converging, then there is a high probability that that trend is not going to go much further. Okay, so something for you to consider. Alright, so look, let's run through this then in an example. So here we're looking at the chart for palladium. We're looking at a daily chart, and what we can see here is that price is in a nice, clean, flowing trend. Absolutely no doubt about that. Clear series of higher highs and higher lows, and then we can see, we've made a higher high here and have pulled back. So the next thing then, obviously we have a trend and play here. We're very happy with that. The next thing that we want to analyze is that our moving averages are correctly aligned. And again, we can see quite clearly, we have our 200 period moving average on the bottom, the 50 period moving average above the 200, the 20 period moving average above the 50, and the 10 period moving average above the 20. Okay, so fanning out quite nicely, good space between them. It just confirms for us that we are dealing with a good, solid, robust trend. Okay, so next thing then we want to see is that price is in the trading zone. So as we can see, we've made a higher high and then price has pulled back, as happens in a trend, and we can see price has pulled back to the buy zone. So we are literally sat right on it at this moment in time. So another factor stacking up to us making a trading decision is in place. And then the next thing that we're looking for is to see a small candlestick in this trading zone. So we can see here we've got a nice small indecisive candle forming on the right hand side of the chart. So if this candle were to close in this configuration, that would qualify as an eligible trigger candle and would meet the rules of our strategy. But before we would consider taking this trade and placing an order, we would also be looking to check that our indicators are converging, so that we have momentum agreement between price and the indicators. So we can see here price has made a high and the previous high was here. Okay, so we've made a higher high, and we can see clearly that the MACD has made a higher high as well, and so has the RSI. So we have got momentum agreement between price and the indicator. So all of the rules are met. So assuming that this candle closes in the current configuration, we would have a viable trading opportunity. And that is something to remember. You always wait for the current candle to close, because they can change quite dramatically as long as they're open. There are no guarantees they're going to stay as they are until obviously they've closed. Once they're closed, then they've closed. Okay, so that is an opportunity to go long here. Okay, so obviously we're uptrending, we're looking to go long. Let's look at this strategy within the context of a short opportunity. So in this example, we're looking at the euro versus the Japanese yen. Previously, we're looking at a daily chart. Here, we're looking at a 30-minute chart. As we've said, this strategy is applicable to any market in any time frame. What we're looking for is a good trending market that meets all of our rules. And in this example, starting from the top, we can see that price is in a clean flowing downtrend. We have a clear series of lower highs and lower lows forming. So that rule is certainly met. The next thing we're looking for is to have the moving averages correctly aligned. So we're downtrending. So we want to see the 200 moving average on top, the 50 period moving average below the 200, the 20 period moving average below the 50, and the 10 period moving average below the 20. So we can see that they're in the right order, they're all flowing downwards, good space between them. So again, very happy with that. We want to see that price is in the trading zone. So we've gone down, had a good strong move down, made a lower low, pulled back then to the trading zone. So we can see we are just right there. So bear in mind this zone is between the 10 and the 20 and just either side of it as well. So we're just either side of it here. So very happy with that. The next thing we're looking for is a small candlestick in that trading zone. We can see we've got a small candlestick here. So again, if that candlestick were to close in the current configuration, we'd be happy to use that as a trigger candle. So the final thing we want to check to verify before we consider taking this as a trade is we want to make sure we've got momentum agreement between price and the indicators. So we can see here we've got our current low in price, the lower low here, and we've got the previous low just here. So we can see that MACD has made a lower low and RSI has made a lower low also. So that being the case, we have got convergence between our price and our indicators. So again, all of our rules are met. We wait for this trigger candle to close. As long as it closes in the current configuration, we would then be quite happy to go and place an order on this particular instrument. So those are the rules. Make sure you've got those written down, and then you can, when you're scanning the markets, you can run through this checklist. If all of the rules are met, then you have a potential trade opportunity. If any of them are not met, then you move along and wait for a better opportunity to come along. And bear in mind, trades are like buses. You know, there's always another one coming along. You don't want to get on a bus that's potentially taking you to the wrong destination. Okay, so let's move along then and discuss strategy management. So we've talked about a very good strategy for you to deploy in trending markets, okay, tried and proven over many years. But how successful you are with this strategy is going to depend on, of course, you learning it and becoming comfortable with it, but how you manage that strategy, okay, how you actually go about managing that trade once you are in it. Okay, so let's talk about how we go about doing that. And of paramount importance to us is how we manage our risk. As traders, we are risk managers first and foremost. Okay, so let's cover the risk management rules for this strategy. So first thing that we need to say is, as traders, our number one priority is to protect the capital in our trading accounts. If we don't do this, the likelihood is that we will not be traders for very long. Okay, it's impossible to be a trader if you don't have any capital in your trading account, and if you are not protecting it, if you're not managing your risk, there's a high probability that that's how things will end up. So the approach that I and my colleagues take to trading and that we advocate is to look to reduce the risk on each individual trade down to 1% of your trading account or less. So what we mean by that is we look to size our positions so that if our stop loss is hit, the loss that we experience will be equal to or less than 1% of our trading account. This means that we can sustain a number of losing trades on the bounce, and it doesn't matter how good your trading strategy is. If you're trading long enough, statistical variance dictates that you will encounter a series of losing trades on the bounce. Now, Let's say, for example, you have a strategy that will win 3 times out of 5. It doesn't mean that how those wins and losses are distributed will be equal to that. So you can't assume you're going to have 3 winning trades, 2 losing trades, 2 losing trades, 1 winning trade. You could quite easily have batches of winners and losers that go on a lot more than that. So you could have 10 winning trades on the bounce. You could equally at some stage have 10 losing trades in the bounce. So if you're managing your risk, you've got 1% of your account going on each trade, it's a lot easier to carry on trading. You'll put less of a hole in your trading account, and just as importantly, you will do less damage to your trading psychology and confidence. Whereas if you're risking 5% and you have 10 losing trades on the bounce, you've put a massive hole in your trading account and you probably will have lost your confidence. So 1% or less is a very good way to trade. It ensures that you will live to trade another day because there are no guarantees what will happen on each individual trade, okay? And that is why we always use a stop loss on every trade that we place. So let's look at our trade management strategy here. So when it comes to this strategy, assuming we're in a long position as we are in this example, we'd look to enter on the break of the trigger candle. So if the trigger candle closes in this configuration, we'll place an order to enter 1 point above the high of that candle, and we'd look to put our stop loss below the low of the trigger candle. Again, I'd put that 1 point below. Obviously, if we were going short, this would be reversed. You would sell on the break of the low and you'd put your stop above the high of that candle. So the difference between your entry and your stop loss is your risk. And how you manage this trade is you have some options. So you could look to close your full position at 1-to-1. And if you are new to trading, that is a very good way to go about trading. Okay. Now, if you're more experienced, you could look to scale out of the trade. So what you would do then is look to close half of the position at 1-to-1. That means that you are then on a risk-free trade because you are at break even. You've banked the profit on half of the trade. That means that if the other half of the trade is stopped out, you are at break even. That makes it a lot easier to then let the remainder of the trade run on and then trail the stop loss. Okay, you can be a lot more philosophical, knowing that the worst that can happen is that you will break even. So that is a very good way to improve your win rate over time. But again, I would suggest if you are new to trading, it's a good idea to close out your full position at 1-to-1, and that means your target will be achieved more often. Okay, so let's take a look then at how we can go about applying this strategy live out on the Next Generation platform. So I'm just going to hand over to one of my colleagues now who will run you through this.
Thanks for a fantastic presentation, John. Hi everyone, my name is Benjamin Charbonneau. I'm a CMC Markets Platform Specialist, and I'd like to show you how you can apply this powerful trading strategy on our Next Generation trading platform. Now, first off, it's worthwhile mentioning that this trading strategy can be effective on any product, but trading products with fewer gaps and generally longer periods can produce more frequent opportunities and generally smoother trends. So what I've done is created a list of some of the most popular products that are tradable on our platform, and I'll be using our advanced linking feature to quickly navigate through this list of product to see if I can find any trading opportunities that are relevant today. I've set up the Next Generation platform with a layout that works hand in hand with this specific trading strategy, the one that John just went through earlier. So what I've included here is a list of 12 frequently traded products and a 1-week chart just to get an idea of the bigger picture before I start analyzing the smaller 4-hour time frame, which is the one I'm actually looking to place trades on. Now, depending on your availability, you could also trade on other intraday charts, such as the 5-minute, the 15-minute, or even the 1-hour time frame, which would generally provide more frequent opportunities. Just below the weekly and the 4-hour chart, you'll notice the market calendar. This market calendar has already been filtered to only display major economic news announcements. Now, when you're trading this strategy, it's worthwhile knowing when these major events are going to take place. I wouldn't want to place a trade just before a non-farm payroll, just before a GDP rates announcement, maybe just before a weekly inventory report if I'm trading crude oil. It's just good to know when these events will take place. Now, some people discount news completely, and that's fine. That's a personal choice. Some people want to trade the reaction to these news announcements. In short, these major impact news announcements is usually what really moves a market to the next level, either to new highs or new lows. So knowing when they're going to come out is pretty crucial. And all we're going to do here is display it, have it in our face. If there's a major report that's coming out and I'm about to place a trade, I might want to open an alert. I'll keep that alert in front of me just to kind of keep in my face so that as I'm placing a trade, I'm looking at how much time I have until that event comes out. And it's just good to kind of be kept in the loop. This again is just another tool in your toolbox, and it just complements your overall trading strategy. At this stage, we're ready to start looking for a trade. But before we do that, let's do a quick summary of the key points of the trading strategy that was just covered by John. So first off, we're looking for a trend that's worth trading. We want to avoid huge shadows, gaps, and particularly range-bound price action. Number two, we generally want to analyze the momentum within that trend. This is where we're going to start introducing those moving averages. So we're going to look at the 10, the 20, the 50, and the 200 period moving average, and we're looking for that clear fanning pattern. Once we have that, then we'll go to step three. Step three is when we really start to stalk the trend. That's where we find that trading opportunity. And at this stage, we're looking for price to come back into that sweet trading zone. And this is where there's usually the space between the 10 and that 20 period moving average. After that, we're going to start looking for that indecision candle. So we've got the nice trend. We found the trend. We've identified the fanning pattern. And now we want to make sure that it's coming back into that trading zone. Once it's come back into that trading zone, which is between the 10 and 20 period moving average, now we're looking for essentially an equilibrium price, so to speak. We're looking for buyers and sellers to essentially not too sure of the direction of the market. This is that indecision candle. That indecision candle, it could look like it's significantly smaller than the surrounding candles. It could be a doji. It could just be some sort of candle that is, again, not very big on either direction. It's not a clear indication of where it's going to go. And that's the indecision candle. Once we have that candle, we want to make sure that the trend is likely to continue, which leads us to step 5. What is the likelihood that this trend that was going up or this trend that was going down is going to keep going into the future in that direction? And this is where we're going to use those oscillators. So we're going to use the RSI and the MACD. We're not using them in the traditional sense here. We're using them a little bit differently. All we're looking for is that they're printing new highs if we're going long, or we're looking for new lows if they're going short. And that's pretty much all we're going to be basing this off to see what the strength of that momentum is. Now that we've reviewed the trading strategy that we covered earlier, let's go ahead and go through the next-gen platform and let's go product by product, and let's go see if we can actually try to find a product that we're willing to trade at the moment. And I'm going to try to simulate this as if you would trade it on your own platform back home. How would we actually set this up? How would we actually go from the process of implementing that trading strategy into the next-gen platform, and how I would actually go about placing a trade. So we're going to really try to kind of show you that strategy in action, and hopefully we find something that we can trade today. So to start things off, let's take a look at that US 30. So the US 30 is the first product in my list. As I click on it, everything changes for the US 30, and I could start to analyze on the weekly time frame. Again, our trading strategy doesn't call anything particular on the weekly time frame, but it's just good to know as a reference that it's been a few months now, 2 to 3 months since early December, that the market, the US 30 or that product, has been essentially climbing. Very, very bullish. The all-time high for that market is around 27,000, and we're at 26,000 at the moment. So very, very bullish on that front. And that's pretty much all I'm determining out of that. Again, we could eliminate this weekly chart and continue the trading strategy as per normal, but it's just good to have there as a reference. Now, what I'm more interested in is this 4-hour chart. Now, when I'm looking at this product on a 4-hour time frame, I'm just going to make this a bit bigger to make it easier to see. I can see here that for essentially since early January, this has been trending beautifully. Again, it meets our criteria of a nice solid trend. The 200 period moving average is looking good. The 50 period moving average is looking good. The 20 and the 10 are going, they're crossing fairly often, as you would expect. And again, there are periods of times that we could have taken these trades over February and January, and it would have been great. It would have been a successful trade, but we're more so interested in what's currently happening. And what's currently happening from what you can see here is that 10 period moving average and that 20 period moving average, they're crossing, and they're crossing a little bit more often than I'd like. they can get close to each other and then fan out again. But when they start crossing over like this, and especially more frequently in a smaller amount of time, that's not something we'd be interested in trading. Again, this is not a clear indication of a fanning pattern. 200 looks good, 50 looks good, but the 10 and the 20 are just crossing too much for our liking. And we can also see this from the MACD oscillator. It's losing a little bit of momentum. It's kind of flattening out a bit. So this is not one that we'd be interested in stocking on a 4-hour time frame. So we're not going to add it to our list. We'll just simply move on to the next product. So if I go on to the S&P 500, again, the S&P 500 has a really strong correlation with the US 30. Again, most of those 30 companies will be found inside that S&P 500. So the charts look awfully similar. And it's the same kind of concept and principle here. We can see that on a weekly time frame, it's been booming since, again, early December. And we can see here that on a 4-hour time frame, a little bit less erratic, again, as you would expect with 500 companies as opposed to 30. But again, they are overlapping a little bit too closely for us. Not a clear fanning pattern, not something that we'd be interested in looking at this time. So we're not going to add that to our list. We'll just keep going. Let's go down to the UK 100. Now the UK 100, again, right off the bat, you can see this is not a clear trend. The 200 looks good on a 4-hour, the 50 looks good, but even the 50 at this level, you can see is crossing the 10 and the 20. It's almost looking like it's died down and it's getting ready to turn around. Not something that meets our criteria, so enough said about that. We'll just move on to the next one. Euro USD is the next one on our list. The Euro USD, even without zooming in and zooming out, you can see that it's been up and down and quite erratic. This is not something that we would be looking to trade. This is one of the things we want to avoid, right? We want to avoid range-bound markets, and it just looks like it's been stuck in that square state and it's been fluttering in this zone for quite some time. So we're just going to avoid that. You can see the moving averages here. They're crossing all over the place. They're going up, they're going down, they're all over the place. This is not a very good trending market at the moment. So again, we don't have to take every trade on every market. If it doesn't look like what we need, we just avoid it and we go on to the next product. Moving on, so crude oil West Texas, WTI. Now WTI on a weekly basis, it's looking pretty good. When it does decide to trend, it trends quite strongly. We can see that it's had a period of decline from roughly 74 down to 40, so obviously a massive drop. It's been coming back, so it looks like it reached the bottom. It's coming back a little bit, so maybe I'd be looking for an uptrend at some point. Now when we look at this on a 4-hour chart, we can see here that actually it was looking really nice. From this period over here, if I put that on the chart, from essentially this period here when all the moving averages would have lined up, this might have been something that we were interested in trading up until about, let's say, this point here. So in this area, in this green square, we can see that, okay, the 200 moving average was looking good, the 50 period moving average was looking good, the 20 was looking good, and the 10 was looking good, and then we were at this point just kind of looking for that trading zone pullback and maybe getting ready to take a trade. And we can see that, yeah, there was a few of those that were offered. We can call this one over here an indecision candle. Maybe something like that. Another one over here. It's easy to look at these in retrospect, in hindsight, and say, oh yeah, we would have taken that trade. But it's just good to see that, okay, if we would have taken that, it would have worked. It would have been successful trades. They would have been profitable. Again, using proper risk management and the proper entry and stop loss and take profit is obviously very key. But at this point, you can kind of see it was really good. Now, this is recent. This big red candlestick here appeared actually today at 11 p.m. So last night at 11 p.m., sorry. Big red candlestick kind of threw our entire thing off. This trend, essentially, we would call this, it's dead on a 4-hour time frame for our trading strategy. We wouldn't be looking to trade this at the moment. It doesn't fit within our bill. It's out of that sweet spot trading zone. It completely crashed it down. You can see the moving averages are turning around, and this is just not something we'd be looking to trade at the moment. So that being said, we go on to the next product. So the next product in the list is the Hong Kong 50. When I click on the Hong Kong 50, it's not too much time that it takes for us to realize that this is a beautifully trending market. If I take a look at the weekly time frame again, we can see that it trended for quite some time upward, had a little bit of a pullback after that December, January, started pulling back, and now over the past, let's say since the beginning of January, we can see that it started a bull run. So again, moving averages on a weekly time frame are starting to turn up. It's starting to look like it's being a little bit more bullish now. So I would potentially be looking to take a long trade. Now when I go down to a 4-hour time frame, we can see things a little bit more into detail. And I take a look at this market. You can tell from this blue line on the market that currently speaking, the Hong Kong 50 is not open. So I'll just change that for now. But we can see nonetheless that it's been a long time and everything is lining up seemingly right just on first glance. We can see that when we look at a Hong Kong 50, we just look at this right here. So the green 200 period moving average, the 50 period moving average, the 20 and then the 10, they're just smooth. It looks like a nice flowing river. It's very smooth. It's fanning out. And then we just quickly take a look at that Euro 50 that we had up. So keep that in your mind, keep that as a picture. And then we look at something like this. So when you look at something like this and you compare that to something like that, it's clear what we're starting to look for, right? We're really looking for that fanning motion, that clear trend, that strong, nice big momentum, and it becomes a little bit more apparent. And as you go from product to product and you trade this strategy for a while, you'll actually start to realize and be very quick at analyzing what product you're looking to trade. So while we have only 12 products on our list, you'll be able to do this with 50, 60, 100 products fairly easily in one trading session, really finding that best opportunity that checks off all those boxes in that trading plan. So when we're looking at this Hong Kong 50, we can see again, moving averages line up. So that's determining, step one. Yes, it is a good trend. Step two, we're looking for essentially for price to come back into that trading zone. And what we have here is exactly that. So this is the first product where we actually actively get to see price retreating into that trading zone. So step one, trend is determined. Moving averages are all in agreement, so we're good so far. Now we're looking for that price to pull back into that trading zone because we're looking for a long trade, a buy trade, and that is exactly what this is. So this candlestick just printed. At 3 o'clock we had a new candle print, so the market's currently closed. And if I want to take a look at what time it's going to be opening at, I'll just take a quick look here. We can see the trading hours here are listed, Tuesday, Wednesday, Thursday. So I'm going to expect this to open up again at 4 p.m. So at 4 p.m., so in about 15 minutes from now, this is going to open up again. And I'm going to be looking for that indecision candle at this point. This big bearish red candle is not an indecision candle. This small red one may have been. This small one again is. That small one is. But don't be confused. This big red candle here, even though it's in our trading zone, this is not the indecision candle. This is just a big signal from the bears, and they're pushing price lower and lower. This price can continuously go down, down, and down. We don't know. All we can do is follow our plan, and at this stage, we're looking for that indecision candle to print. This is a 4-hour time frame, so we have lots of time. So we're going to come back at this around 4 p.m. and take a look at the indecision candle starting to print. And then 4 hours from that time, now we're going to be looking. So 8 p.m. is essentially when we're going to be looking at that candlestick. Well, 7 p.m. on the chart here, but that's the price that we're going to be looking at. So what I'm going to do at this point, because this is something I want to monitor closely, I'm going to take it from the list of products I was analyzing to try to find and stock an opportunity, and I'm going to add it to essentially a shortened list. So the Hong Kong 50 graduates, makes its way into my 4-hour stocking list. So if I set a timer on my phone, or if I set a timer somewhere else on my computer, if I could set a calendar reminder in my Outlook or your Gmail, you're essentially saying, okay, I want to check on this market every 4 hours because that's the market that I'm trading. If you're somebody who has a lot more availability throughout the day and you're trading a 1-hour time frame or a 15-minute time frame, naturally you're going to be checking your platform a lot more often. But in this current video, in this current presentation, what I'm doing is I'm making a list, a shortened list, because I'm looking at a 4-hour time frame, because I'm assuming many of you have jobs throughout the day or you're doing something else, and you're going to be coming back to this. So again, this graduates, makes its way to the 4-hour stocking list, and then I'm going to keep going and see if there's any other products that want to join this list. Now next up is the Germany 30. Germany 30, again, this one's looking quite nice. From this perspective, from a weekly perspective, we can see that it had a pretty big period, long period since June 2018 where it was kind of coming down until December. But again, since the new year, the markets have been rallying. That's the American markets, the German market, the English market. Every market's essentially been almost rallying. And we can see from a low here of 10,200 roughly. Now it's 11,400. Pretty good return this year. But we would be looking for a long transaction on here, so a longer trade. And if we drill down to that 4-hour time frame, just like we did for everything else, we can see that in action. So again, currently speaking, we would be looking for trades probably since about the 15th of February when everything started lining up. And we can see that since that time, roughly around here, and let's draw that, let me just zoom out for you, we can see that this is again something that we would be interested in trading. So 200 period moving average, followed by the 50, followed by the 20, and followed by the 10. Now the 10 and the 20 are not crossing. They're coming close and they're converging sometimes, but they're weaving and they're bobbing. That's a good thing. It's a healthy sign of a healthy trend. And now we can see again, it's starting to separate. What we do see now currently is that this Germany 30 or the DAX, it's gotten that, it's entered the period of, well, do we really want to take this trade? Are we looking for an indecision candle within this trade? That sweet spot is generally between the 10 period and the 20 period, and right now we can see that it's just below the 20 period. This is something that I would monitor closely. I would want to see an indecision candle print potentially between that zone prior to entering that trade. But again, I wouldn't call this a deal breaker necessarily. It's just below that 20 period moving average. I wouldn't call this dead as of yet. Let's wait and see what happens. If the next couple candlesticks end up back into that trading zone, then I would be looking at this to potentially take a longer trade. So what I would do with this product, again, is just add it to our short list, just to monitor. Just because it's part of this list doesn't mean I'll be placing a trade, but it is something that I'd like to monitor closely. And instead of doing an analysis on 12 products every time, well, now I only have to review 2 products and maybe every few days review the list of products. So just kind of getting your idea of how you would use this, of the lists you would start creating based on your available time and whatnot. Next product here is the US dollar versus the Canadian dollar. Again, same thing here, the US dollar versus Canadian dollar. Currencies tend to not trade so well sometimes. They're a lot more volatile, but sometimes they trend quite beautifully, but sometimes they're quite erratic. And we can see here from a 4-hour time frame, way too erratic for what we're looking to do. We would potentially be looking for a short on this, so a sell trade. But again, moving averages are crossing over a little bit too often. It's starting to look fairly decent with a 200 followed by the 50, followed by the 20 and the 10. But again, that 10 and 20 are moving and they're crossing a little bit too frequently for us, so we're going to leave that one alone for now. Moving on to gold. Gold, again, it looked like a really nice trend on a weekly time frame. Quite bullish. It's been coming back from 1160 up to about 1329 now. Pretty strong trend over the last few months. We take a look at a 4-hour time frame. Again, the 200 days moving quite well. The 50 is crossing in and out, and now we take a look at now 200 followed by 50, and then we can see the 20 period moving average crossed over the 10. So this is not something we'd be looking to trade, specifically because of this crossover over here. Maybe before that, so the period leading between, so let's say between here and here. Absolutely, at this stage, during this period, we would have been looking for something, but given the information that came out just now, this sequence of red obviously changing, it looks like there might be a change in tide. This isn't something that we would be interested in looking at or stalking at this stage. We would go next to silver. Silver, again, looking very similar. Moving averages a little bit too all over the place. We have that cross of the 10 and the 20, so we leave it alone. We go on to the next. Copper is the next one, and copper is looking actually really interesting on a 4-hour, but on a weekly, same thing. On a weekly, it's been on a bullish run for quite some time. It might be worthwhile when you're taking a look at this weekly, instead of just looking the most recent one, is you're looking at for that key resistance, key support area. Again, this is not part of the trading strategy that we looked at. It's just a little bit more extra technical analysis. When we take a look at a weekly time frame and we notice resistance and support, these areas are quite significant. So if I take a look at, let's just draw here, the area where price is currently, it's this green square. This is where price is currently sitting in. And if we take a look at just a straight line across, we can see that in fact, price many times has come up and bounced out of this zone, right? It's come back and bounced out of that zone, bounced out of that zone, came back up. So there's some significant support and resistance at that level. And if we keep going even further back, not just in 2017, but we go back, we can see here, even if I go back to 2015, we can see that again, that zone plays into context. And again, over here in 2004, and again in 2013. So what we're seeing is that there is some significant resistance and pressure at this level. multiple times across multiple years, prices come back to this level and felt a significant amount of pressure. All that means is that a lot of people are paying attention to those levels, and that's where you might experience a lot of volatility. And that is currently what's happening. So even though this market has essentially been bullish since 2018, since the beginning of 2019, it's been bullish. It got to that significant area of resistance, and we're seeing a lot of pressure signified by this red candlestick. And if I change timeframes and look at a 4-hour, you can see that those red candlesticks are represented by this. So price came up into that resistance zone. It's encountering that resistance, that pressure, and it's got a little bit of pressure and it's pulling back, and it's right back down into our sweet spot. So again, just because it's at a resistance zone does not necessarily mean it's going to turn back around and pivot, but what that means is it might provide an opportunity for us to get in and ride on this trend. So that's why we pay attention to weeklies. A lot of information that we can get from the weekly chart is quite beneficial for our shorter term trades as well. Now at this stage, looking at everything on the list, the 200-day or the 200 period moving average is good. The 50 is good, the 20 is good, and the 10 is good. This is one of the best charts that we've seen today. Everything lines up well in terms of fanning pattern, so step 1 and 2 are done. Now we're looking back for that pullback into that trading zone, and we can see that here as well. So the black line is that 10 period moving average. That blue line is the 20 period moving average. We can see that the prices come back into that zone, and we can see that the candlestick market is open. It's actually printing at the moment, and it's not moving a whole lot. So potentially this might be the indecision candle. This might be the trigger candle. We might actually have a trade on our hands now. If we take a look at the likelihood of this trend continuing, well, we'll take a look at the high of the price, which was over here, and we'll look at the previous high, which was here. And what we're trying to see, if we go down to this list, all we're looking for is that the current high, so this peak over here, is higher than the previous high. And if the previous high was over here, so we can tell that this second rectangle is higher than this first rectangle. Therefore, this is a confirmation that, yes, it appears as though the trend is strong and momentum is likely to continue, and you're looking for the same thing on the MACD. You're just looking for that this bump over here is higher than the previous bump over here, which again it is. So this would be an indication, again, of one more checkbox that this is likely to continue. So really the only thing we're looking for now is a confirmation of an indecision candle. So it's highly unlikely that we're going to get that during this presentation, so I'll go ahead and just show you what we would do if that would be the case. So let's take a look at this candlestick over here. Let's say that this was the indecision candlestick. In fact, let's say that this red one over here, so this one here, let's say that that is our indecision candlestick. This is the one that we're going to be basing our trade off of. If you take a look at the left over here, we have the open, the high, the low, and the close. So if I put my cursor on top of this candle, I get the actual high of that candlestick. So we can see that 293.60 was the high of that candlestick. And so according to the trading strategy, I would place my buy trade just above the high of that. So what I can do is, let's just say I was going to take something like that. Let's go. Just above the high of that candle. Let's say I wanted to enter around here. Let's say my stop loss, I would place it just below. So again, what we're doing here is this that red candlestick, my stop loss is going just below the trigger, and my entry is going just above the high. So again, stop loss just below the low, my stop entry buy just above the high, and then my take profit can be roughly the same distance between the blue line here and the red line here, the same distance above that. And this is the simple way of doing it. There's another way that you can do where you take 50% of your profits. And again, you can just speak to one of our account managers if you want to go through this trading strategy. But just for now, for this presentation, we'll keep it nice and simple. I'm willing to risk essentially at this point $344. This would roughly mean my account size is about $34,000 if we're respecting the 1% rule. Again, if you only have let's say $10,000 in the account, then I can just reduce this roughly to 5,000 units, representing roughly 1% of a $10,000 account. Again, for more questions on risk management and the math behind this, there's a lot of tricks and tools that you can use, and one of our account managers can kind of go through that with you. But just for this presentation, just let's pretend that we're dealing with a $10,000 account. This means that if I enter this trade and I'm incorrect, in this case I will lose $114.83. If I am correct, I'm looking to make $114.12. Or let's keep it even at $114.84. Okay, just like that. So essentially this is a 1-for-1 reward to risk ratio, and that's essentially what we're looking to do. So we're saying that by taking this trade, there's an enhanced probability that the price is going to go up before it continues to go down, assuming it actually takes off at this stop entry buy order. So we're saying that if price is currently set to where it's at now, it's going to go up, and if it goes up to this blue line, it's going to enter a trade to buy, so an upward direction, and if it continues up, well, I'll make a profit of $114.84 if it reaches this green line, and if it decides to go past this blue line, but then all of a sudden reverse and come back down, well, then I would lose $114.85. That's all this is saying. I can place this entry. It's an order now, it's live, it's active, and I can move on to the next product in my chart. And that's essentially how you would go about placing these trades. After the trade is placed, you can follow all the pending orders that you have here in your order section. If you active orders will be shown in your positions, your pending orders, so orders that have not launched yet, have not triggered yet because it hasn't broken that high of that trigger candle, or the low of the trigger candle if you're going short. That would be displayed here in your order section. Now that was copper. So again, we keep going. We move on to the next product, which is Australia 200. Now the Australia 200, it was looking good for a really long time, but today, again, a lot of red on the streets, bearish, bearish, bearish. This would be not useful to us at this stage. It's broken through the trading zone areas. This isn't something that we would be looking to trade, so we would not add that to our list. And that essentially concludes our quick little analysis of these 12 products. So we're going from product to product, and we're trying to, again, find the product that's going to work for us. Once we find something that's potentially tradable, we added it to our 4-hour stocking list. Now these products, this Hong Kong 50 and this Germany 30, is something that we're going to watch very, very closely. And if we do get an indecision candle, and if that indecision candle gets broken, right, either on the long in this case, so if that high of that indecision candle is broken, we would enter that trade long, and then we would set our risk parameters such as stop loss and take profit, and sit back and kind of relax and see what the market gives us. And that's what we would do on a daily basis. You can do this kind of analysis on a weekly basis. You could do it multiple times a day if you have more time. But this is essentially one way of being able to set up your trading platform and actually put that trading strategy that you just learned to good use. Now, if you have any other questions on the platform itself, on a trading strategy that you learned here today, general questions about CMC markets, your stockbroking account, or anything of that sort, feel free to contact us. Obviously, we have a client service team that's available anytime a market is open. We have global offices scattered across the regions. We have offices obviously in Canada and Australia, New Zealand, and Singapore, and so on and so forth. So there's always going to be somebody there to help you if you need anything. But more specific, we have a new book a meeting service. This service is absolutely free. You can go online, book a meeting with one of our account managers or trading experts or platform experts, and essentially somebody will sit down, share their screen with you, and go through the list of your questions. Now, most times these presentations can take between 10, 15, 20 minutes. They'll really go through the platform with you, make sure you have an understanding of how to use it, and obviously the features that come within it. But specifically because of this presentation, if you have any questions on the actual trading strategy that was taught to you today, well, all of our account managers are fairly familiar with that trading strategy, and they'll be more than happy to kind of guide you through it, set you up as the screen that you see here, and go through and make sure that you have 100% comfort in using that strategy, and specifically on our trading platform. So again, go online and book that meeting when it's convenient for you, and then I'll go ahead and show you how to do that now.